Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on regulation of finance companies, building societies and credit unions. Because yesterday Parliament passed legislation which gives the Reserve Bank wider powers to regulate building societies, credit unions and finance companies. Obviously the Reserve Bank currently regulates licensed banks. Now, what does this mean? Well, from March 2010, finance companies and building societies will have to have accredited credit ratings. They'll also have to comply with a couple of rules. They'll have to have a minimum amount of capital and have to make sure they don't do too much lending to related parties. They'll have to have fit and proper directors, 2 independent directors and an independent chairman. Fit and proper is an important phrase. It means that someone in authority is going to check to make sure someone isn't a ratbag, basically. Interestingly, Rod Petrusevich was blocked from listing his company on the NZX because he wasn't seen as a fit and proper person by the people in control of the NZX. But the really interesting thing about these changes to the way finance companies are regulated is that the Reserve Bank has left the frontline regulator role with the trustees. So this piece is all about whether we can trust the trustees. Now, there has been a lot of criticism of trustees in recent years. People have said they haven't been aggressive enough in spotting problems within finance companies or blowing the whistle early enough. But it's interesting that over the last 6 months or so, their powers have been beefed up. There were some changes last year, which mean that trustees can now appoint independent auditors and advisors to review the loan books and the accounts. And that was done in the case of Dominion and Lombard, particularly Lombard, where Lombard tried to get a moratorium up and the trustee rejected that. They can also force 6 monthly audits, which many people believe is a good thing. However, there are still lingering doubts about how independent trustees can be when they are actually paid by the finance company to be the trustee of the company. That's unlike the Reserve Bank, which obviously isn't paid by the banks. It's an independent body funded by the state. However, will this really matter? Because it's unlikely the Reserve Bank would be able to dig deeper than the trustees anyway. Particularly in the previous model where we had so many finance companies and many of them quite small, the Reserve Bank simply wouldn't have the time or the expertise to really dig down into these loan books and understand what's going on there. So perhaps the trustees are better for that. And also, as it turns out, by the time we get to March 2010, there may not be many finance companies left, or certainly big ones. There should be at least 3 big ones around: UDC, Marrick and South Canterbury. There'll be lots of little specialist ones, particularly consumer finance and asset finance for replacing equipment, that sort of thing, and also some rural finance. So it will be important for those. However, I think there is no sure thing in the world of regulation. As much as the Reserve Bank is very good at regulating the big banks, I don't think having the Reserve Bank regulating finance companies provides that much protection. All it does is reinforce to us all that there is no safe thing. Investors should understand what and who they're investing in. You simply can't rely on the trustees or the Reserve Bank to give you a get out of jail free card on this stuff. You have to do some research. And there's no better place to do that than interest.co.nz. I'm Bernard Hickey with a special report on finance company regulation.